Hi, hello, welcome friends. In this video, I am going to discuss about a fund accounting related classes. So, what is there in fund accounting? What is required for fund accounting? This will discuss. Many companies like these AMCs or banks, what they can do now, some AMC means what's here, asset management companies. This is the persons they can pool money from the investors. The investors may be these students, employees, salaried persons, or small business, etc., etc., and they will invest that money in the market, that is in various assets like shares, debentures, bonds, gold, etc. So and after that they will distribute this money to whoever the invested, this person who is investors is there now, from that person they will share their profits and losses whatever they will get. For example, if you see that Axis Bank is launched one mutual fund in 2021, I think so, and it was pooled some amount and they are invested in shares like companies, bonds, Reliance Jio, TCS, Infosys, Tata, etc. The share price was increased, then the when share price was increased, the fund value also of the assets will be increased. The whatever the amount that was increased, this AMC will sell that shares and get that money, and that profit will be shared to the investors. This is what the I can do. And some banks, what they can do now, these banks they will pool money and they will give this money to AMCs. AMC is the person who have expertise knowledge in different assets. Different assets means here shares, bonds, debentures, or real estate, or whatever they don't know. They know when will be the right time when we purchase the sales and when we'll sell the shares, and they will properly know which purchase we can enter into the market and which price we can sell that price. And they also directly deals with the shares or other assets. They pay more to any assets, or they can buy assets, and they cannot deal with which is not worthy assets. So if the any shares was not worthy, they cannot deal in that case. So maximum they don't get any negative returns or losses in all their investments. And these AMCs always will have, for these AMCs always they have one research analyst team will be existed. So this research analyst team what can do, they will find out the best investment opportunities in the market, and which it will fall in the diversification. Yet the diversification means don't put more eggs in one basket, means it is putting the eggs in different basket is good. So this research team analyze, they will research, they will analyze the best risk management practices, and they will reduce the losses. What this AMC regularly do now, they will try to get the consistent return, not the extraordinary returns or not the extraordinary losses. They will try to get the consistent return whatever the amount by using these hedgings, by using these features, by using these other derivatives contracts. So they know where to invest, they know what to invest, and they know how much they want to invest. So over a period of time, wealthy investors also started investing into these funds, and they will launched by AMCs, the asset managed by them growing. So if you see in India nowadays, if you see in India, this AUM, that is asset under management, has grown from I think of 5 crores it was started, and now it was almost 40 crores it was there. So worldwide also growth is high in the asset under management in mutual funds. To offer these different types of investment opportunities, AMC will launch different funds like equity funds that the invest in shares, or funds those invest in that bonds. So in different types we have three types. One will be mutual fund, we will discuss more on this mutual fund, and one will be private equity, one will be hedge funding. So total fund accounting classes will reveal on these three concepts. This is more three syllabuses: mutual fund and private equity and hedge fund. For this different concept, different job roles will be existed in the market. So only private equity accountant, they have more jobs, only hedge funds they have more jobs, and only for mutual funds and NAV calculations they have different jobs will be existed in the market. So we will discuss on this mutual funds, private equity and hedge funds. So firstly, what will be mutual fund? So mutual fund means this will pool money from the investors, and mainly from the retail investors like salaried employees, and they will invest in money. Whatever we have seen in starting, that will be there here also invest, and they will distribute that amount to whoever is given the money. So we will see in the advertisements nowadays, so many advertisements were coming to for this mutual fund. So here the entry amount, the mutual fund entry amount will be starting from I think 500 rupees is also allowable. So is less amount. So if you want to purchase some shares now, you need more money, but if you want to purchase this mutual funds, you need less money. So even you have less money, you can invest and you can enter into the mutual funds. So here the mutual funds will be allowable to all persons, and they will clearly say that disclination, and just learn all terms and conditions before entering into mutual fund. They will go, and this issue to public only after regulatory like SEBI approval. So before, without having SEBI regulators issues or SEBI approvals, they cannot issue the mutual funds. That is mutual fund related. And after that, private equity or and the venture capital funds, they will pool money from wealthy investors, from where they will get in mutual funds. They will get from retail investors. Retail investors means with the salaried persons or small business persons, that persons. Here private equity means they will go from healthy investors or accredited investors, like we have HNIs, that is high net worth individuals who have more net worth like MS Dhoni, Kohli, some these persons, and individual investors who have like LIC and pension funds, etc. And sovereign wealth funds also there in government different cases. So you can invest more money and ready to take more risk. So this private equity means who are ready to take more risk and who are ready to pay more amount. This is the person. Since these investors can afford to take a risk, these funds are less regulated and controlled by the SEBI, other regulators. So these funds can invest in any assets. So here investors will be afraid to take. So already investors is interested to take risk, so that there will be less regulated and control from the SEBI, and they are not involved with the common peoples. Where mutual funds invested will be common people, so SEBI regulations will be tight in mutual funds, but in private equity they are less regulated or less controlled by the SEBI, and so these funds can invest in any assets. Generally, they invest in shares in private equity. So where they can invest, this concept is also known as private equity. Means they will invest in a private equity companies like startups or real estate companies, mainly focusing on here only, and like real estate companies or office park, shopping malls, etc., and infrastructure like roads, airports, national highways, etc. This is a private equity, where we can see this in private equity case. Or after that, third one which is there, hedge funds. So just a second here. I will take this. Hedge funds means, hedge fund means what? Hedge fund means this also pool money from wealthy investors, and they can also invest in any asset. They can invest in any asset. In previously, private equity means they will pool money from the investors and they will invest in the equity portion, so almost equity portion. But hedge funds, they will invest in any asset, though they do not steal this asset only. Here in private equity, they will almost go for the equity portion only, and once upon a time they will become the owners of the company in the private equity. But hedge funds means they will always go with any asset. Here they invest in public companies, shares, derivatives like futures, options, bonds, currencies, bitcoins, cryptocurrency, etc., etc., whatever they have. Generally the investors invest for short term period and take more risk. So if we go for the private equity, it will be long term. If we see, if you enter into the equity market, you need to stay at a longer period, whereas private equity is a short term. So who want to get instant results, they will go for this hedge funds. This is cases will be existed in the three markets. We have discussed about mutual fund, and we have discussed about private equity, and we have discussed about hedge funds. So these three concepts will revolve around the fund accounting classes. So, and we will at the end of the class, so after completion of this class, we will get full details, full details means what are the entries we will post, and what we will get, what will be the loss, how to liquidate this. These all concepts will be get at the end of the classes. So as of now, this is just an introduction. Just I have given the definitions of mutual funds, and there may be some common companies will be there. AMC companies, asset management companies, they will launch the funds, and they will concentrate where to invest the money by doing the research on stocks, shares, goals, etc. They will also outsource some activities to other companies, called fund companies. So these companies, what they do, they will pool money and they will research, and they will give some outsourcing to fund companies. So I am introducing the fund companies now. These fund admins, they will take care about all the day to day activities of the fund, like what they do. Just a second. Now we have introduced that fund companies. So fund companies, what is this fund companies will do? They will do the transactions. They will admins take care of all day to day transactions. They will take care of day to day actions, and after that, what they can do regarding all transactions, and regarding gain or loss, and reporting profit and loss, and this file returns of tax authorities. They will file the returns of tax authorities, or provide audit support. So they will provide support to audit, conducting the audit. This all will do by these fund accounting companies. These fund admins mainly work in accounting for the fund. So fund accounting is source of income more than the fund that administer. Here more the fees they get from AMCs. Investors pay management fee, fund admin fee, or admin's fee is paid, both charged in the fund and collected from the investors. So that AMC will pay these different amounts to these companies. Here similarly the AMCs, fund admins will be, we have seen in AMC that three types now: mutual fund, private equity, hedge fund. In fund admins, they have these other intermediaries who will act in their case, means the auditor who has completed the audit, and the persons, the custodians. Custodians is the person who keep the assets of the fund like shares in their custody, and that RTA, that is register and transfer agent, who keep the records of all investors in a fund, and they will record any transfers between the investors. So if RTA gives the list of investors in a fund, at a time they will see that final data of the companies, and some professionals will take care of all valuations, tax advices, legal exports, etc. And some brokers will be there, that primary broker and secondary broker, who can buy or sell on behalf of the investors. This is the concept will be introduction. And after that, now we have started with the AMC's types now, that a mutual fund is there, private equity is there, and hedge funds. Now we will see that mutual fund life cycle, what is there, what is the life cycle, how it will start. So it will launch the mutual fund and it will collect money from the investors during the new fund offer period. So first they will launch the mutual fund, and after that they will collect money. This collecting money period is there na, this collecting money period is also known as NFO, that is new fund offer period. We can see in this case new offer period. They will say that this SBI fund was launched from this date to this date, and if you want to invest, you can invest. They will give certain period, that period will be new fund offer period. And after the collection they will invest that amount, investor so invest that amount in the stocks or bonds, etc. And after that completion of this, they will do some, firstly they are launch and collect money in NFO period, and after that they will invest that money, and after that they need to calculate the NAV on daily basis by taking the market value of shares or securities. If you see in the stock market, the NAV will be updated every day at the night, I think 11 o'clock or 11:58 something, they will update every day. And after the calculation of NAV, they will allow for subscriptions or invest by new investors, where fund will sell new invest to investors at NAV prices. So they will allow the subscription by new investors, and they will sell new investor units to investors at NAV prices, whatever this NAV calculated now. For this price NAV, they will sell these new units, and they will allow new subscription we are discussed, and they also allow for the existing persons to exist who want to money, and they can sell their units, and they can redemption, and they can repurchase, so they can settle their accounts by taking units and paying the amounts. And if it has closed ended fund, if it is closed ended fund, they have two categories will be there. One is open ended fund and another will be closed ended fund. So if that fund is related to closed ended fund, the fund will not allow subscription and redemption, rather they will list the units in the stock exchange, so investors can directly buy or sell in the stock exchange. So if we go for open end funded, any person can invest or come out from any pair any time, but in close ended they will specify some time. Up to that time they will not pay any amount to investors, but they will allow, they are listed in stock exchange, and if the person investor unit holder if required money, they can sell their units to other person and they will get the money from the investor. If the open ended funds, they can continue forever if the investors are in that fund. So if close ended, they will sell all investment at the end of the life cycle of the fund, and they will return the money to investors in the close of the fund. And where has AMC fund house invest management will be there, and custodians and fund administrators will be there, RTS will be there, and auditors, tax auditors, these are persons, they will see the helping persons, these are all custodian persons. After that, after the mutual fund life cycle, we will see that private equity life cycle. What is their private equity life cycle? In private equity life cycle, private equity funds pool money from wealthy or accredited investors who is HNI person. So what they will do first, from HNI they will collect money from HNI, that is high net worth persons, and they will invest this amount in the shares, that is second concept, and they will give return to investors after selling that assets. Generally invest in shares of private company or where start that startup or real estate properties like shopping malls, IT parks, infrastructure, etc., etc. So they are all invested in illiquid assets. What is this illiquid assets? Illiquid assets means assets those cannot be sold or converted into cash easily, because these persons are invested in equity. Na? Equity means companies owners. It is not possible to come out easily from the equity portion. So only at the time of liquidation they will get the money, or if company is paying any dividend they will get the money, that's it, and otherwise they cannot go from easily. And here the money whatever they can redeem or withdraw money when they need so, and they generally launch these funds close-ended funds. What they we will see in close-ended funds, close-ended funds means they will specify the time period at the starting itself, lifetime, and they will launch the fund, so they will not allow before that. And since they invest a huge amount of money into one company, and they will cannot exist or sell this investment in short term like 1 year 2 years, they will not get the exit from that cases. So if they exist now they will not get the profits, so they will invest for long term like 5 to 10 years, and they will invest can be increased by good percentage. And when sometimes what they will now, if they are invested in equity portion, equity means if they invest huge amount and at certain portion of time they will become the owner of that company. When this fund only became the owner of the company, and the fund generally involved in the decision making in the company, and so they can understand the business better and suggest the business company best practices of best technology to be used, and what best marketing strategies will be to be followed they will give. And generally these funds launched as close ended, we have discussed that close ended of a lifetime like years, and the cycle of the fund or list of the activities in the fund, there may be 10 years will be existed for this for this PE. There will be maybe 10 years will be the life cycle, and maybe first year, in the first year they will, what they can do, they will launch the fund. So for the launching of the fund what they can do, they will register as a fund and they will give the advertisement, they will accept the investor. This is the what they can do at the first year. And after that 1 to 4 years they will invest this amount, whatever amount they will got from the investors now. So I think 1 to 4 to 5 years, I think 5 to years they will investment paid will be there, and they for the investment opportunity they will negotiate the valuations, and they will invest 10% in first year, 20% in second year, 30% in third year, 40% in fifth year. They will invest based on the market situation they will do. And after the investment they, after the investment they will need to operate that funds, so increasing the business or increasing the business operation, increasing the value of the company, plan for exist or sell, they will go. Or after that they may exist, so after that they may exist means where they will like to sell, or at what price sell that assets or shares, like they will go for IPO in initial public offer, or sell to promoters, or sell to others, or PE funds, etc. And at the last year they will go for the liquidation. Liquidation means closing the fund, and each fund will be separately registered so they can launch the another fund. So here each stake will take sometimes. In the most of the investment these funds are made not popular or investment about these assets, so companies are not publicly available. In the cases will be provided. This is private equity, and where these private equity funds are different when compared to mutual funds. So we will see that PE versus PE versus mutual funds. So what is this PE versus mutual funds? In are mainly due to below some features we will discuss about a PE. This is invest from long term. So PE will be long term, firstly cases. And second one, they generally launch the close ended. So always they will choose close ended funds, and so the investor will have low liquidity, so no cash position we can say. And these funds major stake of the companies have risk is higher, so always risky. So when risk is there, they may chances to get the more return. This is private equity related. And before launching this private equity or before launching this hedge funds, the fund houses, we have discussed that fund houses is there now. That fund houses, what fund houses will need to reach out the investors. In first stage we discussed that we need to reach the investor. Now for that investor, they need to give some document, or they need to give them some pamphlet to, if you go for a real estate now. So if you buyer is coming, the real estate agent, they will give some pamphlet, some booklet about that company, about the houses in west face or east face, ground is there, road is there, and maintenance is there. So some document will be given na. So that same like a document, before launching of this private equity or hedge fund, they will prepare one documents. So in these details in the document, they will give that duration of the fund, that is time of the fund, and where they are investing this fund they will give, and means that real estate or a startup, etc, etc. And track record, what they have done in previous year. This is history, brief history of that company they will give. So this document, what is mean by this document? This document or this prospectus or this pamphlet known as PPM. PPM means private placement memorandum. So private placement memorandum is a document or is a pamphlet or is a prospectus which contain the details like duration of the fund and where the fund is going to invest, what is the track record of this fund, and how they are managing the similar fund earlier. This all details will be existed in PPM, that is private placement memorandum will be there. Once they have details like approximate number of investors interested to invest in that fund and money they want to invest and country they belong, the fund house can get more clarity on the type of registration. So they can go for and number of funds or sub funds they have to register or manage that funds, etc, etc. This will be there. And very common type they use the register this funds is limited partnership. So what we can do, so mostly this will register as a limited liability partnership. So LLP, how they can register LLP, and where all investors and fund managers will become partners. So LLP means that have limited liability, and this fund may be closed after 10 years or 5 years. They will mention in duration now. And these fund houses mainly have two issues will be there for to launching the funds. So what are the issue? First issue will be taxation issue, and another issue will be a regulatory issue. So what is this tax issue? Tax issue means here where the fund has international investors or which common in private equity funds. So they will face double taxation and in some cases triple taxation also. So how will get this double taxation or triple taxation? If we go for tax laws, some laws will be tell that they will charge the tax based on the resident base, and some tax laws say that they will charge or they will levy the tax based on the resident. So some will tell that source basis, some will tell that resident basis, and someone will say that where the fund house is registered in the registered country they will charge you. So if either person company is registered in one, this LLP is registered in one country, and they will pay that amount in that country, and because of a source they are in one country and they become the resident of another country. If you see in India, if you are staying more than 182 days and he will become the Indian resident, so that provision may apply in some normal cases. So this will become the main problem these fund houses will facing. First one is tax issues will be there this funds, and whereas regulatory issues. So some investors or some investors from the specific country may not be allowed to in, or they may have to get more permission to get the approval to invest in a country. If you want, if you see the Pakistan person want to invest in Indian countries fund out, is this possible? No, it is not possible. It is more complications. Or if you go for this two countries is there now, I think Ukraine, Russia, I think so. These two countries there, and they don't want to allow that country to invest here. This country also they don't want to invest there. Or the China, India. If you see that, so they must take the permission from the Home Ministry. They will not allow these cases. So this one common route will be there, and to avoid or to reduce these issues, what they can do now, they will register multiple funds in the same fund structure, mostly this fund in different countries. So if the Pakistan persons are want to invest these funds, so these fund persons will try to locate one branch in their country. They will try to establish one branch there also, and there, so the tax liability can also avoided and reduced to investors from different countries, and regulatory issues also prohibiting will not stop the fund for taking the investors. So if the fund house is establishing in Pakistan itself, they will follow their laws only. They don't want to follow the Indian law as well as Pakistan law. If in Indian batch they will follow Indian law, it is beneficiary to all persons will be there. And here the register has a fund in one country, and which is maybe some country which the main fund is there now, that is become known as master fund, and which is registering as a sub fund, or which is a division now, that division will be feeder. So firstly we have two issues, one will be tax issue, one will be law issue. To avoid these laws or to avoid these issues, what we have given the idea, we can register. So for example, one is in India already will be there, and they don't allow this Pakistan, and they don't want to allow this China. So what we are giving the suggestions for fund houses, you can register one in Pakistan. So this is the suggestion we have given. Okay, they will register. What will come now, that fund already came from USA. If you see USA, so this is the main fund. So main fund we also known as master fund, and whereas this has registered one branch now, and this is registered as one branch. This is known as sub fund or feeder funds in tax haven countries. If if this is in Mauritius or some tax haven countries is there na, they will register as a sub fund or feeder fund. So the year they have master fund, and one feeder fund will be registered in cases. So once the list of investors are finalized, they will also finalize the structure how to register. That then generally this will be registered as LLP only, that is limited partnership only, and they will decide where to register. They must register as one master fund and one feeder fund. They will get registered as a one master fund and one will be feeder fund, and after that they will take commitment from investors. So what is that commitment? Maximum amount an investment can invest in that fund. So how much amount they will invest, they will close or first to close, in which fund they will close and which fund they don't allow, and they will second capital, second ending and third ending, fourth ending. So they will discuss all these matters first itself. This is the case. So they will close means, here close means no further investment from investors in that fund once launched. And whereas once the firm is registered as a LLP, that is a limited partnership. Limited partnership means that persons will have limited partners. So this limited partners, what is the limited partners? Most of the private equity or hedge funds are related as LLP, the limited liability partnership firm, like mutual funds register as a trust, and they will pool money from the different persons, and they will register as a separate funds, and these all partners and all fund managers will part, this all limited partners will be part of this fund, and this fund will register with the some name will be there. LLP company is there. I think if, my name is Haribabu, so HB LLP, this will register. These persons will become the partners or fund managers, will part of this funds will be there. So this person is known as limited partners. So those are the investors in a fund that is registered as LLP, so limited partnership, and they don't want to participate in the business in that entity or fund, rather they will only invest the money and take the profit. So some persons, so whoever invested, they will part of this fund only, but some person they don't have the interest, or some person they don't have that time, and some person they don't have the that much of experience in that cases. So they don't participate what fund he is doing, what fund he is doing. So LLP is there and LP is there, they will part, but they don't participate. All persons will not participate. So and their liability also limited to the extent of their investment, or is this investment also known as commitment. So whatever they committed na, that commitment, to the extent of commitment, whatever this LLP done, and to only this commitment, up to this commitment, this LPs will be liable. And here one person will be there. These all are LPs, that is limited partners. One main partner will be there. This partner is known as general partner, and he will register as the LP, and this partner manage the fund and take the decision where to invest, when to invest, or where to sell, and this partner manage the fund and business. This partner will have unlimited liability. So that here what we can discuss, that LLP is there, LLP, LP persons is there, and GP persons is there. This person's liability will be limited, and this person liability will be unlimited. This is the summary what we have discussed. But what they can do now, this person, see, just a second. So this GP means general partner, and GPs may not always require to be a individual persons. Listen, GPs will not require to be a individual persons, and they can register as a companies. They can register as a companies. Now company is registered, and company will have assets, that is capital, some amount, and when the LP is get any loss, this person's liability will be limited, and this person liability will be unlimited. But this person is not individual person. If this person is this company, only to the extent of this capital, to the extent of this net assets value, it will be liable. I think so. I assuming you are understanding, or I will give one example here. It is better to understanding. For example, what we can do now, there is some LLP. There is some LLP. So firstly, LLP will be there. Simple case, and it has raised the capital will be I think 500 rupees capital it was raised, and it got the loss of 1000 rupees. It got the loss. Second one. Now who will come first? All LPs will be liable, and LPs invested only 500 is the commitment. Because this is the capital, and this capital used by this LP, and this got this loss. This is the case scenario, and LPs will get the liability to the extent of 500 only. And where has this after 1000 minus 500 it will become another 500 na. And if there is GP, if there is GP, that is general general partner, if there is GP, GP is the person, GP is the person will be liable to this 500. If this GP is a company and this company has capital, this company has capital 2 crores, or this company has net assets 2 crores. Here the GP will be only this company. So then loss will recovered from this GP. Here GP become the company na. So this loss will be to the extent of 2 crores only, because company is a different person from the person. Always company is a separate entity. So this they can get the amount from the company to the extent of 2 crores only. Now that became so many persons will register as a GP is a company, that is limited companies will be registered, and they will kept some capital amount. To the extent of this capital only it will liable, and this person will be liable only to the extent of this commitment amount. So when a LLP get the capital from 500 and it invested and it got loss of 1000 rupees, he will get from he will set up this 500 from the LLPs to the extent of 500. They will liable. After this 500 they will go to general partner, but here the general partner is a company, and that company has net worth is 2 crores. They will get only 2 crores, the 200 crores it is better. 200 crores, 300 crores is nowhere getting. This is there in LP, LP or general parchment. And whereas this is they must enter one limited partnership agreement na, that is the limited partnership agreement, that is LPA. This is the agreement between general partner and limited partners in a fund that is registered as limited partnership. And these entities, this agreement will have all the details what this LLP is going to do and what it is doing in future will be given. And what is there in LLP? In LLP, what is the time or what is the duration will be existed, that LLP will be there, and what is the management fee at time, like if the partner will pay 2% fee or 3% fee of the fee in that fund, and how the profit how the profits will be distributed between the partners, they will see, and all terms and conditions will be there. And here profit will be payable or profit will be distributed. Normally we will go with one provision will be there. That provision will be waterfall provision. We will discuss later what is waterfall provision, we will discuss. So what is there in LPA agreement? In LPA agreement the tenure will be there, duration of the fund, and what is the management fee terms will be there, and after that that will be how the profit will be distributed between the partners. Normally waterfall provision will be discussed, and the terms and conditions has how and when fund will be liquidated, and if the is expenses, any expenses like maximum expenses is there, how much they can utilize the expenditure they will give here. And here we have discussed about when the partner that LLP is there, for this LLP, yeah, LLP, LPC is there and GPC is there, they will give the capital. This capital we are called as commitment, we have explained in before itself. This commitment means the maximum amount an investor is ready to invest in a fund. Here each investor, here this each investor will need to give some assurance, will need to give some commitment to certain amount, and based on their capacity, based on their willingness to invest in that fund at the launch time, so they must give some their commitment. This commitment only this LLP can do the business. Based on that business they will get the profit, they will distribute, and to the extent of this commitment only these LPs will be liable, and they will give that commitment at the starting of the fund itself. And fund generally may call to take 10% of money in first year, 20% in second year, 30% in second year. That may decide based on the requirement they will list. And when it want to close, when the fund is finalizing the list of investors and their commitment and they announce close, which means new investors are not allowed, so they will take some persons only, one GP will be there and some LPs will be there and their commitment. And once the fund is closed, they don't allow the new investors to get in this fund. If for example SBI private equity is there, SBI private equity has closed in this month, December month, they have raised some amount 100 crores and from some 10 investors. If you want to invest, if you now want to invest, they don't allow you because the finalized list will be there and fund has closed. If for example if they need more money, what can they do? For example we'll see that. So LLP is there, they have 10% investors will be there, or they are raised 10 crores, and after the end they will not allow the any person, we know that. But what they wanna, they need more money. After 1 year they need more money, after they need 5 crores for example, 5 crores they want. So what they will go na, they will be second close, all the closes also called as subsequent close. So first will be close will be there for first commitment, and after that if they want more money and they will accept more investments from these 5 crores, they may get from the old person or new person. If old person is not able to give na, then they will go for the old person itself. And if this old person is not given, all are new persons, and they need also to pay some interest on this different amount. For example I think so it is better to rough. LP is there, 10 investors will be there, they are raised 10 crores, new persons will be there and required 5 cr, all are new persons and different amount will be 5 cr, means this 5 cr will be there, means on this 5 cr they need to pay the interest amount, because of they do not of the end of the fund they will pay the sharing ratio what they discussed in the LPA agreement. So the new person will need to pay some interest, that is compensation, like a compensation to the old investors because they are invested in last year itself. That is the case. And after that we have discussed that master fund and feeder fund. So what is this master fund? We have discussed master fund means where the fund master fund is registered, and where has the feeder fund means which is feed money. This is feeder fund, and they will see cases will be there. I think this master fund and feeder fund class will be taken in tomorrow. Okay.